Welcome to The Explainer. Today, we're diving into a real paradox, something that sits right at the heart of innovation, the wild, high-stakes world of venture capital. It's an industry that literally builds the future by, well, betting on failure. So let's just start with a question that seems to fly in the face of, every business school textbook. In a world that's obsessed with profit and dodging risk, why would anyone create an entire industry that funds ideas that are pretty much designed to fail? I mean, think about this for a second. Out of all the startups out there, only about 1% ever hits that legendary unicorn status, a valuation of over $1 billion. So what happens to the other 99? Most of them just disappear. They burn through all the cash and poof, they're gone. So how on earth is this a business model? What's the secret sauce here? Well, this isn't just reckless gambling. It's actually a deeply calculated strategy. And it's all built on a really powerful mathematical principle that forces us to totally rethink what success, risk, and reward even mean. Okay, so this is where venture capital, or VC, steps in. See, unlike a bank that wants its loan paid back on a nice, predictable schedule, VC is what you'd call patient capital. It's money that gets poured into a company that might just be a couple of founders with a wild idea on a napkin. Investors know they might not see a dime for 5, 7, maybe even 10 years, if they ever see one at all. The secret that makes this entire high-wire act work is something called the power law. Now, most things in life follow a bell curve, right? Results kind of cluster around the average. But venture capital, it's a power law world. And here, the average is completely irrelevant. All that matters are the crazy outliers, the 1 or 2 massive wins that don't just pay for all the other losses, but generate all of the profit for the entire fund. And this quote just nails the mindset. VCs aren't trying to build a portfolio of pretty good companies. Nope. They are on a hunt for that one massive outlier, the next Airbnb, the next Google, that can return the value of their entire fund and then some. It's a game of grand slams, not base hits. All right, so if you're out there hunting for these super rare, world-changing companies, how do you actually build a strategy around that? What's the formula for trying to catch a unicorn in the wild? What's really interesting is that even the language here is changing. For years, everybody was obsessed with finding unicorns, that billion-dollar valuation. But really, that's just a number on paper. It's a vanity metric. The new focus? It's on finding dragons. These are the companies that deliver actual cash returns to the investors. It's that huge difference between just potential and real tangible success. And that brings us to this seed planting metaphor. It is the perfect way to understand how venture capital is different from its cousin, private equity. VCs are planting seeds, right? They're hoping a few of them grow into a giant forest. Private equity, on the other hand, is more like a house renovator. They buy an existing stable company and then focus on making it more efficient, more profitable. One is about creating, the other is all about optimizing. And you know what? Today, that whole seed planting process is getting a major tech upgrade. Modern VCs are using AI to just scan mountains of data, market reports, academic papers, you name it, to spot the next big trend faster than anyone else. It's this incredible blend of that old-school human gut feeling with the raw power of machine learning. But let's flip the script for a second. What does it actually feel like to be the founder inside this system? To wake up every day knowing the odds are just massively stacked against you? It takes a very specific, almost bulletproof mindset to handle that kind of pressure. So, how do they do it? Well, a lot of them find strength in a really old philosophy, Stoicism. The core idea is actually super simple, but so powerful. You focus only on what you can control. A founder can't control the stock market or a new competitor popping up, but what they can control is their work ethic, how they treat their team, and how they react when things go wrong. And that becomes their anchor in the storm. The Roman philosopher Seneca just said it perfectly. For a founder, the fear of failure, the fear of running out of money or letting people down, is often way more painful than failure itself. A setback? That's just a data point. It's a lesson. But the anxiety? That's the real monster. And there's another powerful idea from existentialism, this concept that existence precedes essence. Now that sounds complicated, but it just means this. You aren't born a successful founder or a failed founder. Your identity isn't written in stone. It's defined moment by your actions, by the very act of building, trying, and creating. The work is who you become. Now, if we zoom way out, all of this disruption and failure isn't just random chaos. It's actually a core feature of our economic system. The economist Joseph Schumpeter gave it a name that's stuck ever since: creative destruction. It's the engine of progress, where new things are constantly destroying the old things to make way for the future.
And you see this cycle absolutely everywhere. I mean, the rise of the personal computer meant we needed fewer typists, but it created this massive demand for software developers. The internet created whole new jobs, like webmaster or social media manager, that just plain didn't exist a couple of decades ago. It can be a painful process, for sure, but it's this constant churn that keeps pushing the economy forward.
But, okay, let's be real. A system that celebrates disruption, that runs on a winner-take-all model, well, it's bound to run into some pretty serious ethical questions. What happens when that relentless drive for hypergrowth slams up against basic responsibility? One of the core challenges here is something called the principal-agent problem. Let's break it down. Investors, the principals, hire a founder, the agent, to grow their money. Simple enough. But the founder might be more motivated by building a cool product or becoming famous, or maybe even just taking a big salary, even if those things aren't the best for long-term profit. Their goals can start to drift apart. And when that misalignment gets really bad, the consequences can be devastating. The most infamous example, of course, is Theranos. In its single-minded pursuit of a massive valuation, the company just cut corners, faked its results, and literally put patient lives at risk. It is a tragic, powerful reminder of what happens when the pressure to grow just completely steamrolls basic ethics. Now, in response to things like that, a new framework is really starting to take hold: ESG. It pushes both investors and founders to think beyond just the bottom line and to consider a company's impact on the environment, its social responsibilities to its people and community, and its internal governance, basically how it's run. The whole point is to try and build healthier, more sustainable companies from the ground up. And the same focus on impact has sparked a really exciting new field called venture philanthropy. It basically takes the whole VC playbook, making big bets, giving deep support, aiming for huge scale, but it applies it all to nonprofits. So here, the return on investment isn't money, it's measured in social impact. It's pretty cool. So when we pull back and look at the big picture, you start to see that these different investment models aren't just, abstract financial ideas. They are actively and powerfully shaping the world that we all live in. So you've got these two incredible forces. Venture capital is like the engine of creation, right? It funds the disruptive ideas that are going to build tomorrow. And private equity is the engine of optimization, making the world we have today run better and more efficiently. Both of them are fundamentally designing our future. And that really leaves us with one last big thought. These investment models are so much more than just finance. They are the tools we're using to literally build society. They decide which problems get attention and which ideas get a chance to change the world. So the real question is, what kind of future do you think is worth funding?